Britain's home prices have gradually increased for decades, but with rising mortgage rates and shifting demand, it now seems set to alter. Britain's real estate bubble is a national exercise in economic deception and the largest lie we've ever told. The dizzying rise of the real estate market has provided a substitute for economic growth, one that people have accepted because it seems permanent. An expensive house that sucked up a lifetime's wages became the savings account, the pension, even though real wages have not increased much in more than 20 years, and today's workers' pensions are mostly paper thin. Wealth passed down through inheritance is now starting to dissipate. UK housing prices fell more than expected between December and January, and for a fifth consecutive month, marking the longest decline since the 2008-09 financial crisis, as higher mortgage rates hit prospective buyers. According to mortgage lender Nationwide, property prices fell 0.6% between these months. They fell for the fifth time since September last year to £258,297, from a high of around £274,000 in August. Such a long-term decline has not been seen in 14 years. Yearly home price growth decreased from 2.8% in December 2022 to 1.1%. The Bank of England is dealing with the current levels of inflation, which are above 10% in the UK, by raising interest rates. This puts pressure on the market because it's now more expensive to borrow money and take on debt both as a consumer and as a business. So in theory, this reduces demand and causes prices to fall. However, as many keynote commentators frequently mention, inflation affects people differently, and it's very much the same in the property market. Many of you have shared your own stories, and please keep them coming below, that housing prices in the area where you live increased as compared to the national average or not. According to Nationwide senior economist Robert Gardner, economic challenges are expected to persist because of rising costs. He continued, affordability of mortgages would remain hard due to higher interest rates, and many people were finding it difficult to save for a down payment because of this increase. The Bank of England reported that lenders approved 35,000 fewer mortgages in December than expected, compared to more than 46,000 in November. Except for pandemic lockdowns, this is the lowest number since January 2009. The largest building society in the nation predicted that it will be difficult for the market to regain any momentum in the short term. Reports show that the drop in approvals followed a significant slowdown in mortgage applications following the government's mini-budget in September. The base rate set by the central bank is anticipated to rise by 4%, the highest level since the financial crisis of 2008. In comparison to 2021, affordability issues for homebuyers have become more acute across all regions of the UK. Research from Nationwide shows that rising mortgage rates have increased the cost of servicing a typical mortgage. For a sector that has seemed to defy gravity for years, crunch time has arrived. According to the Halifax Bank, Threadneedle Street's Monetary Policy Committee is prepared to increase official borrowing costs for the 10th meeting in a row, even though mortgage approvals are already 30% below their pre-pandemic levels and home prices are down 4.3% from their peak in last August. As borrowers adapt to a period of consistently increasing interest rates, further declines are unavoidable. The city is preparing for a rate increase of 0.5 percentage point to 4%, and for the rate to stay at least this high until the bank is confident that inflation will sustainably reach its target of 2%. The consensus among analysts is that house values will continue to decline through 2023, one forecasting a peak-to-trough decline of more than 25% after inflation is included. Housing prices in the UK tend to rise for structural reasons, such as strict planning regulations, a tax structure that favors home ownership, and a steep decline in the number of new homes being built during the 1950s and 60s. But there are occasional blips in the trend. On track to be one of those break years is this one. A protracted boom fueled by historically low interest rates has peaked. Ms. Kennard, while giving an interview, said, "As we enter 2023, the housing market will continue to be impacted by the broader economic environment, and as buyers and sellers remain cautious, we expect there to be a reduction in both supply and demand overall, with house prices forecast to fall 8% over the year." According to Andrew Sheets, chief cross-asset strategist at Morgan Stanley, the decline in housing prices indicated that central banks' tightening of monetary policy to control inflation was starting to take effect. The current interest rates in the UK are rising, with the Bank of England setting them at 3.5%. Pickering said that the largest annual drop occurred in the late 1980s, before the early 1990s housing market crash and recession, while the second largest fall occurred during the global financial crisis in 2008. Although economists, including us, expected a housing market downturn, the monthly drop in the December survey far exceeds our and the consensus expectation. Due to people losing their jobs and having to sell their homes in a down market, the early 1990s saw a doubling of unemployment, which prolonged and intensified the housing market slump. A repetition of the record-breaking repossessions is unlikely at the moment due to the low unemployment rate, but Wishart predicts that values will still drop significantly. The scale of the correction in house prices was important, according to Callum Pickering, chief UK economist at Berenberg, because the wider UK economy was sensitive to large swings, either upwards or downwards. According to the latest Royal Institution of Chartered Surveyors bulletin, the impending downturn is likely to be on par with the early 1990s, when interest rates peaked at 15%, and the global financial crisis, when the UK banking system was on the verge of collapse. The headline house price balance, the difference between RICS members who said prices were rising and those who said they were falling, was negative 42% in December compared to negative 25.7% in November, the lowest monthly balance since October 2010 and the largest annual drop since 1978. However, mortgage rates have risen dramatically in recent years, so say goodbye to 1.5 to 2 mortgages and hello to a new world for first-time buyers. Some of the best rates on the market are currently around 5%. You may recall that mortgage rates skyrocketed and many mortgage deals were pulled from the market when Liz Truss and Kwasi Kwarteng dropped their extremely well-thought-out budget and rebelled anyway. We're still not out of the woods yet, and I wouldn't bank on interest rates falling anytime soon. In general, increased mortgage rates will cause a significant repricing in the housing market this year, even in the absence of forced sales. The nominal peak-to-trough decline in house prices of 12% that we anticipate is less than the declines of over 20% observed in 2007 and 2009 and 1989 to 1992, and it only returns house prices to their level from March 2021. But take note that in practice, it only amounts to 27% drop. I'll give you a quotation from Nationwide regarding their assessment of the health of mortgage owners. Almost 85% of mortgage balances are at fixed interest rates, ensuring that balance sheets are protected from rising borrowing costs at least temporarily. Since the financial crisis, affordability testing has been a key component of mortgage lending and is typically stress tested at an interest rate higher than the current one, which means that while it will be challenging, the vast majority of those refinancing should be able to manage. Interesting, isn't it? There are so many moving parts to this topic, and our experiences will vary depending on where we live right now for what it's worth. I believe that house prices will fall this year, but based on the reports that we have, I believe that the decline will be temporary. 4 will be relatively small, and I believe it will be in the 5 to 7% range on average. However, with double-digit falls, I do consider the question. Unless we're talking about smaller parts of the market like those with multi-million-pound flats and mansions, which is a much smaller section of buyers, although who knows, in that market, with a weak pound, those big properties in London and big cities start to look more appealing to overseas buyers too, and they don't even need a mortgage, speaking from my experience. Thanks for watching. If you found this video helpful, please hit the like button and consider subscribing to our channel for more great content.